Your daughter is born today, and within 72 hours, before she's even smiled at you for the first time, she already has a five-figure decision waiting for her, made entirely by you. Not diapers, not daycare. A financial fork in the road that could be worth tens of thousands of dollars by the time she's 18, and hundreds of thousands by the time she retires. On one side of that fork sits the 529 plan, the old, reliable workhorse that millions of American parents have used for decades to pay for college. On the other side sits something brand new, something that didn't even exist a year ago. Something with the president's name literally stamped on it. The Trump account. And if you're a parent, a grandparent, or someone who just wants to understand where American family finance is headed in 2026, you need to understand both of these, because getting this choice wrong doesn't just cost you money. It can cost your child decades of compound growth. So stick with me, because by the end of this video, you'll know exactly which one fits your family, or whether, like a lot of savvy planners are now doing, you should be using both at the same time. Let's start with the account almost every American parent already knows, the 529 plan. This is a state-sponsored, tax-advantaged investment account built for one primary purpose: education. You contribute after-tax dollars. The money grows completely tax-free, and as long as you use it for qualified education expenses, tuition, room and board, books, even K through 12 private school tuition up to a certain limit, you never pay a dime of federal tax on the gains. Many states sweeten the deal even further with a state income tax deduction just for contributing. And here's a feature that's made the 529 even more attractive in recent years. Up to $35,000 sitting in a 529 plan can actually be rolled over into a Roth IRA, Bipartisan Policy Center, for the beneficiary, which means even if your kid gets a full scholarship or decides college isn't for them, that money isn't trapped. It can pivot into a retirement nest egg with no penalty. The 529 is flexible on ownership too. Parents, grandparents, aunts, uncles, family, friends, anyone can contribute. And you as the account owner retain control even after the child becomes an adult, which is a comfort for a lot of parents who worry about handing over a six-figure sum to an 18-year-old. Now let's talk about the newcomer, the account that's been dominating financial headlines since the middle of 2026. The Trump account, officially known under the tax code as a Section 530A account, was created by the One Big Beautiful Bill Act, and contributions officially opened on July 4th, 2026. Think of it less like a college fund and more like a custodial retirement account for your child that starts accumulating the day they're born. Here's the headline hook that got everyone's attention. The federal government makes a one-time $1,000 seed contribution for every eligible child who is a U.S. citizen born between January 1st, 2025 and December 31st, 2028. Fidelity, Internal Revenue Service. As long as a parent or guardian files the election, typically through IRS Form 4547 or the online portal at trumpaccounts.gov. That's free money, sitting there, waiting to be claimed. On top of that seed deposit, individuals can contribute up to a combined $5,000 per year, and employers can kick in up to an additional $2,500 annually toward that same limit as part of a workplace benefit program. Fidelity, Bipartisan Policy Center. Similar to how a 401k match works, except this is for your child, not for you. Contributions from charitable organizations and government entities don't count against that $5,000 cap at all. Center for Retirement Research, which is how you get situations like the Michael and Susan Dell Foundation pledging $6.25 billion to add $250 to the account of every child under age 11 who wasn't already eligible for the government's seed money. Bipartisan Policy Center. But here's where it gets technical, and this is the part most people skip past in the headlines. The Trump account has what's called a growth period, which begins at birth and runs until December 31st of the year before the child turns 18. Center for Retirement Research. During that entire stretch, the money is essentially frozen. Generally speaking, no withdrawals can be made at all before the child turns 18. Center for Retirement Research. Fidelity. No exceptions for medical emergencies. No exceptions for anything short of the death of the beneficiary. Once your child hits that January 1st threshold in the year they turn 18, the account essentially converts into a traditional IRA and becomes subject to all the same rules as any other traditional IRA. Internal Revenue Service, meaning withdrawals before age 59 and a half will generally trigger both ordinary income tax and a 10% early withdrawal penalty, Northwestern Mutual. With a short list of penalty-free exceptions like paying for qualified higher education or putting up to $10,000 toward a first home purchase, Northwestern Mutual. And the investment menu is deliberately narrow. Unlike a brokerage account where you can buy individual stocks or exotic ETFs, Trump account funds must be invested in low-cost mutual funds or ETFs that track the S&P 500 or a similar index of primarily American companies, with expense ratios capped at just 0.10% and no leverage allowed. Fidelity. That's actually a feature, not a bug, for most families, since it forces a boring, diversified, low-fee approach instead of letting anyone gamble away a toddler's nest egg on meme stocks. But it does mean you have far less control and far less diversification than you'd get inside a self-directed brokerage account or even a flexible 529 plan. Now here's the tax mechanic that trips up almost everyone, and it's crucial if you're trying to decide between these two accounts. In a 529 plan, when you eventually withdraw the money for qualified education expenses, you owe zero federal tax. Period. Full stop. In a Trump account, the tax story is messier. Only the private, out-of-pocket contributions from parents, grandparents, or the child themselves actually create what's called basis, meaning that portion comes out tax-free. But the government's $1,000 seed money, any employer contributions, and all the investment growth on top of everything does not create basis and will be fully taxable as ordinary income when withdrawn. Center for Retirement Research. The Center for Retirement Research actually ran the math on this. Imagine an account funded with $4,000 from parents and $1,000 from the government pilot program that grows all the way to $40,000 by the time your child retires. Only that original $4,000, just 10% of the account's value, comes out tax-free. The other 90% gets hit with ordinary income tax, Center for Retirement Research, which, depending on your child's tax bracket, decades from now, could be a meaningfully bigger bite than the flat, permanent tax-free treatment a 529 plan offers for education spending. So which one should you actually pick? Here's the honest, unvarnished answer financial advisors are giving right now. If your primary goal is funding college, a private high school, or graduate school, the 529 plan remains the superior tool. Hands down, because of that guaranteed tax-free treatment on qualified education expenses and the flexibility to roll unused funds into a Roth IRA if plans change. If your goal is jumpstarting long-term retirement wealth, giving your child a decades-long head start on compound growth they can't touch until adulthood, and especially if your child was born between 2025 and 2028 and qualifies for that free $1,000 government deposit, the Trump account becomes genuinely compelling. Essentially free seed money you'd be leaving on the table by ignoring it. And here's the strategy that a lot of financial planners are quietly recommending to clients right now. Don't choose one. Use both. Open the Trump account primarily to claim the federal seed deposit and any employer match, since that's essentially free money with no real downside. And keep the 529 plan as your primary vehicle for education savings, where the tax treatment is unambiguous and the flexibility is far greater. Layering both accounts means your child gets a runway for college and a runway for retirement, funded in parallel, starting from the day they're born. There is one more wrinkle worth knowing before you open either account, and it's about state taxes. Federal tax rules do not automatically apply at the state level, and some states, California among them, currently do not conform to the federal tax treatment created for these new Section 530A accounts. Brooklyn Phi. The same patchwork situation that's existed with 529 plans for years, where some states offer a deduction and others don't. So before you commit real money to either account, it's worth a quick conversation with a tax professional or look at your specific state's Department of Revenue guidance, because the account that's optimal on paper nationally might look different once your state's rules are factored in. Here's the bottom line, and I want you to walk away from this video with real clarity, not just more confusion. The 529 plan is the proven, flexible, tax-free workhorse for education, built on decades of track record, and it should still be the backbone of most families' education savings strategy. The Trump account is the new kid on the block, a retirement-focused vehicle with genuinely exciting free money incentives, but with real restrictions on access and a messier tax picture on withdrawal. Neither one is a scam, and neither one is a silver bullet. The families who come out ahead in 20 years won't be the ones who picked a side in some online debate. They'll be the ones who understood exactly how each account works, claimed the free money they were entitled to, and built a diversified, multi-account strategy for their kids starting as early as possible. If this video helped make sense of a genuinely confusing new landmark in American family finance, hit that subscribe button because we're going to keep breaking down exactly what these changes mean for your wallet and your children's future, one video at a time. Thanks for watching, and I'll see you in the next one.